Welcome to the deep dive. We've got quite a stack to dig into today. Three quarterly letters from RFG. There's one from October 2024, and then two pretty recent ones from April 2025.
Yeah, these are great because they offer, a much deeper look than you get from just the daily news. It's straight for their perspective on market events, financial thinking.
Exactly. And our goal here really is to pull out the key stuff, the aha moments from these letters. We want to cut through the noise and help you get informed efficiently.
Right. It's about finding that signal in all the noise, tailored for what you're interested in, give you the bigger picture.
So what ground are we covering? Looks like market volatility, obviously. Some specific investment strategies. They talk a lot about lower price stocks, smaller companies.
Yeah, and then there's some potential flags raised about the U.S. mortgage market. That's definitely something we need to unpack.
Also, the difference between what's happening in the financial markets versus the real economy.
That disconnect, yeah. Plus, the huge topic of AI, artificial intelligence.
Yeah.
Its impact. And then views on energy, other tech that's coming up.
Okay. And we'll try to keep it balanced. The letters talk about challenges, but also opportunities. We just want to provide some clarity, some context.
Sounds good.
All right, let's dive in. First up, navigating this pretty uncertain market. That April 2025 letter really kicks things off there, doesn't it?
It does. It starts right off acknowledging the uncertainty after the inauguration, and importantly, how the news cycle tends to amplify the drama.
Right, always chasing clicks or eyeballs. It's a good reminder that the loudest voice isn't always the most informative one.
Definitely not.
Yeah.
And it means you have to be kind of careful about where you get your context from.
So what about the near term? Stocks, bonds? The April 25 letter suggested we could see maybe some short-term dips.
Yeah, potential declines. It wasn't like a hard prediction, more a possibility to be aware of.
And the advice tied to that seems really practical. Reviewing your cash needs, your income needs for the next couple of years.
Exactly. It's not about panic selling. It's about making sure your immediate needs are covered so your longer-term investments can, stay invested and ride things out. Sensible planning.
Okay, this bit's interesting. The author sees a potential, maybe, upside to all the global uncertainty, with tariffs, foreign policy stuff creating a bigger gap between U.S. and foreign markets.
Yeah, that's a fascinating point. The idea is that this disconnect could actually be an advantage. See, market downturns, they're often about fear, right? And they last until prices get low enough to look attractive again.
Makes sense.
So by focusing on those lower-priced sort of value stocks and smaller companies over the past couple of years, the strategy was hoping to maybe cushion the blow if markets fell.
And maybe bounce back quicker.
Potentially, yeah. It's about seeking that margin of safety you get with assets that aren't priced for perfection, especially when things feel uncertain. Less reliance on pure optimism holding up.
And the logic for smaller companies specifically, less intense focus on quarterly earnings, maybe more adaptable, and potential buyouts too.
All part of the rationale, yes. Plus, they can sometimes pivot faster than the huge corporations. And connecting that globally, the decision mentioned to mostly steer clear of heavy China exposure in emerging markets. That fits too.
Why is that?
Well, due to the geopolitical risks and, frankly, the legal structures there being less stable, less predictable, it's seen as adding a layer of risk that, in this strategy, they wanted to minimize.
Gotcha. Now, going back to that October 2024 letter, it shows the strategy was already playing out, right? Small caps and value actually did better than large growth in Q3 24.
That's right. And international stocks were starting to look interesting, too, mainly because their valuations were lower.
It really hammers home that valuation point, doesn't it?
It absolutely does. Now, the letter did note that the models lagged their benchmarks slightly that quarter.
Oh, why was that?
Mainly because of the bond holdings and having low sensitivity to interest rates. So when rates were maybe expected to fall, these portfolios wouldn't get as big a boost. But the overall positioning was for that longer-term resilience, banking on those cheaper areas eventually coming back into favor.
Okay, market uncertainty covered. Let's shift to something maybe a bit more worrying from the April 2025 letter. Risks in debt, especially housing. They flagged this as a potential trigger for a downturn.
Yeah, the focus is specifically on the U.S. mortgage market. The concern stems from these COVID-era relief programs for mortgages still being around.
You mean the ones that let people pause payments?
Exactly. The argument in the letter is they should have ended sooner. They've basically kept a lid on foreclosures, even for borrowers who are seriously behind on payments.
And those stats they quoted from the Wall Street Journal?
Wow. rising debt to income for FHA borrowers, but foreclosure rates staying super low despite delinquencies. It's quite the disconnect, isn't it? And the scale. The FHA making almost as many incentive payments to stop foreclosures as they did new mortgages insured last year. That's significant.
Huge intervention.
And it's not just the FHA. Fannie Mae, Freddie Mac, they have similar home retention programs. It seems like a system-wide thing.
So for someone listening who owns a house, maybe thinking of selling in the next year or two,
Yeah.
what's the potential implication?
Well, the worry expressed is that when these support programs do eventually wind down, you could see a faster drop in housing prices if a lot more properties suddenly hit the market.
Because supply goes up, demand maybe doesn't keep pace.
Precisely. And then there's the leverage factor. Mortgages amplify everything. The letter gives an example. Even a, say, 10% drop in your home's value can wipe out a much bigger chunk of your actual equity if you've got a big mortgage.
Right, because the debt stays the same. Ouch.
It's just math, but yeah, it can be painful.
Interestingly, though, that same April 25 letter mentions the market dip in March 25, and it notes the RFG portfolios actually held up better.
Yeah, it suggests that the focus on lower-priced stocks in international markets provided some relative outperformance during that wobble. A real-world test, I suppose.
And the weaker dollar helped the international side, too.
Correct. When the dollar weakens, returns from foreign investments translate back into more dollars. So that was a bit of a tailwind for those holdings at that time.
Okay, let's talk about the election. Often a huge focus, but these letters kind of downplay its direct market impact. October 24 called it a false flag.
Yeah, basically saying people worry too much about the election itself driving markets. The letter pointed instead to a maybe more concrete issue, the challenge of refinancing a whole lot of U.S. Treasury debt that was coming due in early 2025.
Because of how the Treasury issued debt previously.
Exactly. The argument was that this is likely to have a bigger impact on markets, debt, and stocks, no matter who won the election. More structural issue, perhaps.
And they brought in some expert perspective on this too, right? Someone named Daniel Crosby.
That's right, the behavioral science guy. His point, backed up by others quoted like Nassim Taleb and Philip Tetlock, is basically humans are just terrible at predicting the market impact of political events.
The stats are pretty bad, aren't they? Wall Street forecasts, expert predictions, often no better than guessing.
Pretty much. Taleb says our track record on predicting big, rare events is zero. Tetlock's research shows experts barely beat chance. It's humbling.
So if you can't predict that, what can you focus on?
Valuation. Which brings us back to that real estate saying, well bought is half sold.
Okay. Makes sense.
The October 24 letter highlighted the gap. The S&P 500 looking expensive relative to history in other global markets, while things like small caps and developed international stocks looked, well, cheaper, undervalued.
So the strategy is stay diversified globally, but tilt towards those cheaper areas.
Essentially, yes. Broad diversification, but with an overweight to areas with lower valuations. Still investing in good companies, mind you, often through active management, but trying not to overpay for them. It's risk management, really.
Makes sense. Now, shifting slightly, but still practical, the October 24 letter also mentioned wealth management, specifically tax planning.
Yeah, a really important point, especially if you've got investments in taxable accounts, maybe built up some capital gains.
What was the specific service mentioned?
Analyzing the previous year's tax return and then doing planning for the current and next year. Proactive stuff.
That sounds genuinely useful, helping manage the tax bite.
Definitely. The letter encouraged clients to reach out about it.
Okay, let's move towards the end of 2024 and into 2025 reflections. The April 25 letter starts on a personal note, acknowledging the mix of experiences clients had.
Yeah, blessings and tragedies, highs and lows, expressing gratitude for the relationships. It also briefly mentions the firm was looking for a strategic partner to, beef up support and resources.
And there was something called a master list of goals.
Right. Sounds like a comprehensive wealth planning tool sent to clients.
Yeah.
Looking beyond just investments to wider financial life goals. Proactive planning again.
Then it gets back to the markets. The Trump bump after the election, which apparently fizzled.
Kind of, yeah. Initial enthusiasm faded, and the market seemed to go back to being driven mainly by just a few huge mega-cap tech stocks.
And they highlighted that difference between the S&P 500 and the S&P 493, basically the index without the top 7 stocks.
Exactly. A stark difference in performance in 2024. showed how concentrated the gains were. Same divergence seen between large cap growth and, say, value or core stocks.
Which leads perfectly into the next big theme, AI. The April 25 letter calls it the major market story of 2024.
Absolutely. Seen as a huge driver with potential to really democratize productivity eventually. Spread the benefits widely.
The valuation question comes up again, right? Especially for the big names like NVIDIA, Tesla.
Very much so. Their stock prices were baking in massive future earnings growth. Huge expectations. The letter contrasts the price-to-earnings ratio of the RFG portfolios with the overall U.S. market, showing the portfolios were positioned more defensively, valuation-wise.
Lower PE ratio.
Considerably lower, yeah. And this is tied into the broader view expressed that the U.S. market overall looked overvalued, especially when you factor in high government and consumer debt levels.
Which sets up this really interesting idea about a disconnect.
Right, the disconnect between financial markets and the real economy. The letter proposes thinking about 4 economic classes: working, making, extracting, and financial.
Okay, break those down quickly.
Sure. Working is wage earners. Making is manufacturing production. Extracting is natural resources. And financial is, well, finance, capital management, investments. The argument is that the experiences of the first 3 are increasingly diverging from the last one.
And that economic news often reflects the financial class's perspective.
That's the suggestion. Like job stats might look okay overall, but mask falling full-time jobs or stagnant wages, which hits the first 3 classes hard. But the financial news focuses on what it means for interest rates, which matters more to the financial class.
Or inflation. Good for assets held by the financial class, maybe, but painful for the working class buying groceries.
Exactly. The pandemic capital influx and subsequent inflation seen very differently depending on which group you're in. Rising stock prices are great if you own stocks, not so great if your rent and food costs are soaring and your wages aren't keeping up.
It's a provocative way to look at it, but the letters don't just focus on risks, right? They do see opportunities.
Oh yeah, definitely. The April 25 letter balances the concerns. It sees potential for AI's impact to actually spread out beyond just the Magnificent Seven. That's a long-term positive.
And energy, big focus there too.
Huge. Expectation of a shift to an all-of-the-above energy strategy, potentially lower costs, more production. Nuclear power is mentioned specifically, even small modular reactors, SMRs for private use. Lots of potential growth there.
Wow, okay. Any other emerging areas?
Briefly touches on quantum computing, robotics, self-driving cars, all seen as significant future opportunities.
And how is this translating into portfolio changes?
Well, the plan mentioned was to add some mid-cap growth exposure, maybe swapping out foreign small cap and also adding the NASDAQ Q index, the QQQ, to get more U.S. tech exposure.
So leaning a bit more into tech and growth.
A bit, yeah. But the key point made is that even with these changes, the overall portfolio valuation is intended to stay below the market averages, still keeping that value discipline.
Got it. Okay, last section here. Interest rates, gold, crypto. What's the take?
Well, it notes a difference in signals. The Treasury yield curve might be suggesting one thing about inflation or recession, while the Fed is saying something else. A bit of divergence.
And the idea that the 10-year Treasury could hit 5%.
Yeah, but interestingly, the letter suggests this might be driven more by the technical factor of refinancing all those short-term Treasury bills Treasury Secretary Yellen issued previously.
Less about inflation or recession fears driving it.
Potentially, yeah.
Yeah.
More of a supply-demand dynamic in the Treasury market itself, a consequence of past decisions.
What about gold?
Still seen as a good diversifier in non-retirement accounts. So maintaining that existing exposure.
And crypto, Bitcoin?
Expresses interest, yeah. Looking at potentially adding some exposure, maybe Bitcoin directly or through ETFs, for diversification, but also as a potential hedge against inflation or regulatory overreach.
And silver gets a mention too.
It does. Noted as interesting because it hasn't appreciated nearly as much as gold or Bitcoin, and historically it looks undervalued relative to gold, another potential diversifier.
Okay, wow, we covered a lot of ground there, pulling from those 3 letters. Let's try to sum up the key takeaways for listeners.
Sure. I'd say first, a generally cautious near-term market outlook mentioned in the later letter. Second, some specific worries about the U.S. housing market due to those ongoing relief programs.
Third, the absolute importance of valuation in the investment strategy. That came through again and again.
Definitely. Fourth, the AI-driven nature of the recent market, but also the potential for that impact to broaden out.
And fifth, those emerging opportunities, especially in energy, nuclear included, and other new technologies.
That covers the main points, I think.
Great summary. So maybe a final thought to leave our listeners mulling over.
How about this? We're seeing this potential for market bumps, maybe corrections, alongside these really powerful, transformative technologies like AI and shifts in energy. So how does a long-term approach, one that really focuses on value and diversification, help you navigate both of those things, the risks and the opportunities in the years ahead?
That's a really good question. Balancing the immediate caution with the long-term potential. Definitely food for thought as the landscape keeps changing.
Indeed.
Well, thank you for joining me to unpack all of that. And thanks to our listeners for tuning into this deep dive.